Good evening. I'm John Batchelor. This is the John Batchelor Show. Mary Kissel, my colleague and friend and co-host. She is the editorial board of the Wall Street Journal and the host of Opinion Journal, WSJ Video. And today, Mary took on the big topic of the moment. It happened during the day, and we were watching it very carefully. This is not the Republican debate. We will move to that. But we begin with the Federal Reserve. This is a global news story, and there's much to say given the fact that nothing happened. That's right. Janet Yellen, chair of the Federal Reserve governors, the decision was to leave zero to be zero. That is the federal funds rate, meaning the best customers are charged nothing to hold money, to borrow money from the Federal Reserve, and borrow they do. That is an aspect of the easy money that Wall Street loves, and the rise of Wall Street these last years, 6 years, 7 years since we've been at zero, is a deal of the success of the Federal Reserve zero. The Wall Street has been restored from the lows in the 6,000s in 2009. However, the debate these last hours was start the rise, a quarter point, not going to hurt anybody, why not? And then the debate. Mary, you spoke with someone who worked at the Federal Reserve and was skeptical of the decision today not to raise rates. Skeptical is diplomatic. There sounds to be alarms. Who was she, and what is the upset?
Danielle DiMartino Booth. It's a bit of a cumbersome name, but a name that everybody should remember because she worked at the Dallas Federal Reserve under Rick Fisher, who was considered a so-called hawk at the Federal Reserve. He was always worried that the central bank was going to get things wrong and that they would hold rates too low for too long. And as a result, investors, businesses, would take their extra money and they can't put it in the bank because there are low interest rates, so that they'd go all across the country and all around the world looking for higher returns or so-called higher yields. So I had Danielle on the show today to ask her, does it matter if the Federal Reserve raises rates from near zero to 0.25 percentage points higher? Because the central bank has kept rates low into the 6th year of our expansion. The last time the Federal Reserve raised interest rates, John, it was June 2006. You remember what a different economy it was in June 2006? The iPhones didn't even exist. Now, consider this, and Danielle spoke to this as well. It's very difficult to know when you keep interest rates this low for this long, in fact, for an unprecedentedly long time, where people are putting that extra money. A lot of investors point to the stock market. Danielle also pointed to commercial property. She had an extraordinary number there. I don't know. Is that on your notepad,
Yeah,
John?
It is. She says the report is on Mary's show. Commercial property is now 20% higher than it was in 2007 at the peak of the property bubble.
That's right. The peak of the property bubble. So the question then becomes, okay, we can observe certain markets, the stock market, the commercial property market, emerging market stock markets until very recently when China fell off of a cliff. But we really don't know what other problems might be lurking out there. So for the Fed to choose today to keep rates at this near zero level for longer, it only compounds the danger that once they do start raising rates, that we could be in for some nasty surprises.
You asked a question you need to explicate for me. You asked Danielle, and she gave you a very cogent answer. Have we missed a cycle? Has the Federal Reserve missed a cycle? What does that mean, Mary?
Well, a normal cycle, a normal growth cycle is that economic activity gets going. It's healthy activity. Companies start hiring. They start having to compete for workers. They have to pay more for those workers. Wages rise. People spend more. And eventually, the economy gets to a point where you start to take risks that may be overheated. And so the central bank comes in and it says, and as wages are rising, the central bank raises rates to get people to pull that money back into banks to cool the economy down. Now, we have had 6 years of an economic recovery. Well, in a normal cycle, the Federal Reserve would have raised interest rates
to about 3%.
Yeah, years ago.
Right.
So Danielle's point is the Federal Reserve, by not raising rates, may have sowed the seeds of asset bubbles and other problems that we just don't have any.
She used the metaphor of still waters run deep. In other words, we can't tell where the $200 trillion...
Correct, yes. But she still thinks that the Federal Reserve should raise interest rates, and we think so too on the editorial page, because raising rates by 20.25 percentage points is nothing. And it would actually send a signal that the U.S. economy is healthy enough, growing at 2%, that the Federal Reserve is confident enough to raise rates. So Danielle concurs with us on that. We had John Cochran on the op-ed page this morning. He says no. We had a bit of a debate about that.
All right, I'll contribute what I've had the last days. Larry Kudlow, our colleague, has indicated that he believed Janet Yellen would stand firm, and he was pointing to the overseas doubts, the Chinese doubts, the question of deflation. Does it exist? It does in the commodity markets. And Steve Moore of the Heritage Foundation joined me yesterday, and I was asking, come on, Steve, this is your job. You got to tell me what they're going to do tomorrow. He said they're going to raise rates. That's the right thing to do. We're going to start the raise cycle because, and he underlined, that strengthens the dollar. That attracts investment money to America, which is a good thing because that allows us to build plants, to hire workers. The Federal Reserve, in strengthening the dollar, is protecting America. So I asked the politically devious question, is Janet Yellen the chairman of the Federal Reserve of the planet or of the United States of America?
No, according to her comments today, she seems to be the central banker of the planet. But, you know, the U.S. Federal Reserve has been that banker for the planet for a very, very long time. We are the world's reserve currency.
Right.
You know, but again, I just go back to the issue of cycles. The problem with the Federal Reserve today isn't just the fact that it may be inflating asset bubbles and we may be in for a fall, or the fact that they're taking risks with their balance sheet that we've never seen before, trillions and trillions of dollars on their balance sheet, extraordinary
Yeah, I've
power.
lost track of how many. It was 2, 3, or 4, somewhere in there.
The fact that they've distorted prices, it's the uncertainty that also damages our markets. Businesses, banks, they can't plan because they have no sense of the contour of this business cycle. Raising rates would have the virtue of also signaling to the markets, okay, guys, we're not in such extraordinary times. This isn't a crisis. We can get back to normal courses of business.
That raises, all of a sudden you trigger the memory. John Taylor at Stanford, and I've spoken with him, with Larry, over the years. Rules-based Federal Reserve. We don't have a rule from this because we did not hear today why it is we've delayed when and if they're going to raise, because the unemployment number, they pointed to that for a long time. It's very low. There is no inflation, or the inflation they can find is even lower than they expected to find. So what is the Federal Reserve basing its decisions upon?
Well, the problem with a rules-based approach with respect to Mr. Taylor is that you're looking at data that has to be backward-looking, and it may not give you the result that you want, which is some perfect cycle where the Federal Reserve steps in at just the right time. I would prefer that the Federal Reserve stick to a mission of stable prices, and that Congress would pass a law and get rid of the dual mandate that forces the Federal Reserve
inflation and jobs.
To look at inflation and jobs. That's simply absurd. You have a Federal Reserve with a $4 trillion balance sheet that hasn't raised rates since 2006. Do we really think that a 0.25 percentage point hike right now would do anything for jobs? Has anything that they have done, all of these extraordinary measures, has it done anything to the economy? No, because the problem is not the monetary side of the economy. The problem is the fiscal side of the economy, the layers upon layers of red tape, the crushing tax burden, the uncertainty in healthcare costs, the crippling of our most productive industries by Washington. That is the problem on top of what the Federal Reserve is doing.
Mary Kissel giving you a very concise version of the editorial board of the Wall Street Journal for the last 6 years.
For free.
Mary Kissel of the Opinion Journal at WSJ Video. I'm John Batchelor, and we're going to the debate next.